And so now in Europe, it's particularly the crisis
So welcome to, this is the last of the money learning events in the Slow West Money Learning Series, which the emphasis is on using your money for sustainability and for justice, not just for profit. So we've had 3 sessions, really interesting sessions on where can you invest and feel good about your investments. And today's, this afternoon series, I have to confess, is the one I'm the most excited about. It's learning about banking. And I know Marty, and before I knew Marty even had anything to do with a career that has to do with accounting and money, I knew him as a person really interested in social justice and creating a better world. So I was so glad to hear he was somebody that was also going to be going into the money world. So we had some great advocates there. And he is going to talk about banking, like what's the story behind banks? Where do they get their money? What do they do with the money that they make? Are they supporting the community? Who's getting supported by the banks? What kind of services do they really provide? Or are they out to just get a profit from us? So, and a comparison between banks, co-ops, credit unions. And with that in mind, also, I stopped into the Frontier Credit Union, that's our most local credit union on Richmond Road, and I met Patrick Tardif, who's right there in the back, and he got me so sold on Frontline Credit Union, and I brought brochures and all kinds of stuff because it's a beautiful thing that those guys are doing, and he decided he'd just come and answer your questions and meet you today. So we are all sponsored by Slow West. Slow West is a West End neighborhood grassroots organization to support sustainability, to learn together, to support more justice, to support a healthy business environment in the West End, and so on. And we will continue with learning series. I think the next one is going to be about learning how to communicate with nature, which will probably be coming in the fall. Very exciting learning series. So I think that's all except to hear a little bit from you. So you know me, my name is Joyce, and I'd like to hear just your first name, and for Marty to hear and Patrick to hear as well. What is it you'd most like to learn about banks, about money, about credit unions, and so on? Just a headline, and then Marty and Patrick can speak into that. So we would just start with you.
Hi, I'm Shelley, and I thought it was an interesting topic, and I'm interested in, I guess, the ethical aspect of banking, and find out what I can.
I'm Brenda, and that's what attracted me to the ethical part. So I want to learn so I can make a good decision.
My name's Estelle, and I missed the other 3 because I work every Thursday evening, but anyway, here I am.
We got you for one.
Yeah. And I'm really interested in this whole field, so and I want to know why I should go, let's say, to a credit union rather than a bank. And I mean, I've seen some movies that make you really think that the banks are not interested in us at all. So I'd like to know a little bit more and what the alternatives are.
You ready to speak, or are you still recovering?
Something made me choke.
Why don't we come to you last, so you just get a little chance to...
I'm Kim, and I have some investments in banks, but I really want to get rid of them. I want to go somewhere else. I want to know more about what the alternatives are, and does moving to a credit union or a co-op or something always mean that you don't get as much return on your investment?
That's a big question.
As Joyce said, I'm Patrick Tardif, and I've been working at Frontline Credit Union now for a year and a half, and I do the marketing and business development there. So Joyce has a few of our brochures, and what we've done is a full rebranding and a real focus on community and what Westboro and One Family and family finances, so making your family life and finances more simple. And as Joyce said, the alternative to the bank, the credit union, we really focus in on our members and their needs and what they want. So profits are always generated back within our group or within the community or our bond groups, which I can get into later if we have some time too. But that's what I've been doing. So I've been involved for a little bit now and always a member since I was a kid at Frontline. So if you have any questions, feel free to chat with me after too.
Thanks. And Adam is our resident video person.
Indeed.
And a wonderful support for all these programs. But
So
you have a
if you missed
particular.
the other ones, they're on the website. The Slow West website, if you want to catch them after. But myself, I was interested in cooperative housing, cooperative banking, those kind of things. So I had a lot of questions. So I'm glad there's this one to go to. And yeah. So it fit well with the other investment because I'm just starting to, with work, benefit packages and like pensions, those kind of things. What's in there, and it's trying to find a good place to kind of choose or mix with other banking. So cool. Okay.
And you made it.
Yeah, I did. Just thought while I'm in the neighborhood.
We're just giving our first name and any particular question you have around banking, money and banking, so Marty can directly say.
Oh, I see. Yeah. Well, my name is Faye, and I have some RSPs, and I'm trying to find another place to put them. I know self-directed is the word, get them from there. And so I'd really be interested to explore.
Karen Atkinson, please call 272. Karen, 272.
And fun. Yes.
Yeah, I bank both in the credit union and Bank of Montreal. The Bank of Montreal branch is very handy for me. It's walking distance from where I live. And generally speaking, I'm satisfied with them. On the other hand, I have been banking with a prominent credit union in Ottawa, and initially I was quite pleased with them. They gave me a very good mortgage payment. It was, I paid my mortgage up in 3 years. It was just
Joshua, please call 282. Josh,
I
282.
became disillusioned with them, and I don't find them satisfactory. They were not very good in handling my investments, and so I am actually wanting
Pia, please call 240. Pia,
just stick to
240.
Bank of Montreal for now because it suits me.
Well, hopefully this talk today will just help you understand how banks work and how they fit into our world, wherever you have your money, so that you understand it better and can work with it better. So without any other introductions, Marty can start, and I just appreciate that he's here, leaving his family on a gorgeous Sunday afternoon as a service to us to learn. So welcome, Marty.
Well, thanks for coming. Joyce asked me a while back, she said, do you know of anyone who might want to talk about the banking system? And I don't know how we ended up, but we ended off onto this huge tangent about the banking system, and I ended up saying, okay, yeah, I'll talk. And I'm delighted to be here. At the same time, I am filled with an absolute huge amount of trepidation because the banking system
Page for Joshua 281. Page for Joshua 281.
built on a number of concepts that when you start to dig into them, don't make sense from the way we expect the world to work. And so I'll kind of dig into that as we go along. But really, what we're going to look at here is a very kind of high level look at some of what makes our current banking system operate, how it interacts particularly with money and currency. And that's been one of my interests for a long time, looking at how it is that we as human beings relate to one another, how it is we work in creating a community that is supportive of everyone. And unfortunately, or fortunately, money and exchange are a very important part of that. I didn't start out in finance or
Turn off the pages.
I didn't start out in finance or accounting. I actually started out in doing supportive community work through first some private healthcare companies, and then through the United Church of Canada. My own educational background was as a home economist, specializing in family studies and looking specifically at how family structures relate to each other, especially looking at the economic patterns within families. So I've for a long time had a large interest in how it is that we relate to one another economically. Then about 10 years ago, I decided to make a career shift, and so I went back to school and trained to become a certified general accountant. So I became a certified general accountant while living in the UK, and while living in the UK, I also served as the treasurer for the First Dorset Credit Union, which was a very small credit union, had started about 7 years previously, and had total assets at the time of just under a quarter of a million pounds. So very small compared to what we understand credit unions here to be. But it was a very interesting time for the UK because they were starting to look at how payday loan lenders were really affecting the poorer people across the UK. And so the government had decided to act by investing in credit unions and asking the credit unions to take on that service of short-term lending to people who would otherwise have trouble getting credit. I was also involved while there, and actually prior to leaving, in LET systems, and I'll speak to them a little bit at the end because I think they're an interesting opportunity. I currently work for the USC Canada, which is an international development organization working on smallholder farming and the protection and development of biodiversity in the seed stock around the world. And we've recently just started working on a seed program in Canada to help reintroduce some diversity into our farming practices here in Canada. And so in that context, we also look at seed banking, which is another kind of entirely different way of thinking of banking. There we go. So I thought we'd start off by just saying, well, why is banking an issue for us? Why do we even want to really talk about it? First of all, I think a couple of people have mentioned that there is an obscene amount of money being made by our Canadian banks. Year after year, quarter after quarter, we hear of new records being set for their profits, for their dividends, and no seeming end to that growth, despite what the rest of us feel as a tightening and a restriction of the economy. So really, what's going on here? How is it that the rest of us seem to have no money, and the banks are still increasingly pulling more and more out? The second one that I'm sure everyone's aware of is the sense that the risky behavior of banks, less so in Canada, but certainly in the United Kingdom, Iceland, the United States, was what precipitated the financial crash in 2008. I think it's useful to kind of name that those lending practices of the banks precipitated the crash, but the economy in general had created a context of instability that really allowed that crash to happen. And so while we can say, yes, what happened at the banks helped accelerate that, I think there are underlying problems that we as a community, as North Americans and as global citizens, need to think about addressing in the more long One of those things in terms of the banks is that they have an enormous power to affect the Canadian economy. Recently you will have heard Mark Carney, who's been the Bank of Canada governor, appealing to the banks to rein in their lending and their mortgages, to be more conservative about their lending practices. And from all of our perception outside, that seems to be falling on deaf ears. The banks are, once again moving into competitive interest rates, trying to drive up their mortgage lending as much as possible, and that has an ongoing effect on Canadian house prices, on inflation rates, all of those kind of things. And so, despite our government, whatever you might feel about their perspectives, and the Bank of Canada saying this is the way we want to turn the economy, the banks aren't cooperating. And as part of that not cooperating, are really having drastic effects on how we survive. So, what are banks for anyway? If they have that much power, if they have that much influence, what are they? I'm going to spend the first part of this presentation actually talking about, where banks came from, what they do, and the kind of service that they provide to us as trying to explain this. Because our current banks are rooted in that and different. So we have to go back, to the very beginning and start thinking about, well, what is money? How did money get formed? I think from our perspective, the important thing to note is that humans are interdependent. We cannot survive alone. We're born, and without the support of a community around us, we would die. As adults, without the support of a community around us, we would die. No single individual person has the resources and the capability to survive on their own. So we need other people's labor, we need other people's products in order to make a living in the world. Alongside of that, my mouse is not working. Nothing's working.
Here, there. There.
Okay, so alongside of us needing other people's labor and products, we also need to have our own labor and products be recognized for the value that they're contributing to the community. And so all of that basically means that we as human beings need to have an economy. We need to have a system through which we can exchange goods and services and have the value of those goods and services recognized and shared. So initially that would have started out simply with barter systems. I need a haircut, I can do some accounting. So I need to find a barber who needs an accountant. We can trade our services. You can see that from that is very limited. You need to find a person who has an exact need that matches the skill you offer, and on the other hand, has what you're looking for. So that kind of matching in a barter system is very difficult to achieve. One of the solutions to that is a system called concurrent multi-party exchange, where we basically create a circle of people who all have things to exchange, but maybe not directly with each other. And so I might be able to provide accounting services to somebody who runs a lawn mowing business, but I live in an apartment, I don't need lawn mowing. But somebody else needs the lawnmowers and can cut my hair. And so we together all get down and say, okay, let's do this. And we, at the same time, offer those services and make those trades. And that way, we all get recognition for what we're offering. But those kind of exchanges are extremely hard to broker. So that then developed into what would be called promissory notes. So I go and get a haircut, and I write down on a sheet of paper, I, Martin Settle, owe you 1 haircut. Pass it over, and that haircut can then be exchanged later on for some other service. And so those kind of promissory notes started to be passed around. Part of the issue with those kind of that kind of trading and that kind of exchange is the value of a haircut may not then equal the value of a lawn mowing service. And so someone might then say, oh, well, what the heck, I'll mow your lawn for you anyway, that's okay, I'll, you know, whatever the difference is, we'll let it go. But how do we ensure that we're getting a fair compensation for what we're being offered with? Especially as if I gave my IOU, essentially my promissory note, to Joyce, and Joyce then tried to trade it with somebody else, that person doesn't know me. That person doesn't know that I'm good for it. And so Joyce is likely to receive less in value for that exchange of that note because that third party doesn't trust the note. So we're going to come back to that concept fairly often because trust is probably the most important thing in our monetary system. So as people still experimented with how do we value exchanges, they started to come up with forms of coinage. So using feathers to mark value. I'll give you 6 feathers for that haircut. You can take those 6 feathers and 4 of them can pay for a lawn mowing service. There's these kind of early currencies experienced in just about every culture around the world. And they work, sort of. The question within them becomes, how do you ensure that the value being exchanged is actually the value of the service that was delivered and not just the effort of somebody to find or create new tokens? So I've given you 6 feathers. That lawn mowing is going to be 8 feathers. So you go out and find a bird. You know, that there's no productive labor that's necessarily being contributed to the community in order to gain that extra coinage. So then we started to develop intrinsic currency. These are the early coins that were usually based on some kind of valuable metal or gemstones in some cases, where the coin itself had a value. And so that value could then be relied upon because that piece of gold that I traded you is going to be worth a piece of gold no matter what happens. And for a very, very long time in our history, this is what our coinage consisted of. The coins were measured. You'll even find our quarters have those little notches around them. Those little notches exist on our quarters so that people can't shave them off. So they can't shave off the weight of the quarter and use that valuable metal to create more money. It's a holdover from those kind of securities that are built into the coins. So the intrinsic value was a very, very important piece for a very, very long time. Probably, in fact, until the early 1800s. And the changing, moving away from coins and notes that had an intrinsic value is something that probably came alongside the development of the double entry accounting system. Not to blame the world for, not to blame all the problems of the world on accountants, but there is a strong connection there. So the problem with intrinsic currencies are, first of all, that they're limited sources of them. That also means that there is a limited quantity of the currency. So if we, between us, had 100 coins, that we could pass around. We could pass those coins as often as we want, but we couldn't go beyond them. And it actually creates a false scarcity, because my labor and my time and my ability to contribute to the community is not limited by Joyce's quantity of coins. But Joyce's ability to compensate me for that labor is based on the amount of coins that she has in her purse. And so the limitation in the number of coins of intrinsic value in that kind of system basically limits the output that people are able to provide to the community. There are other problems. Carrying around gold is heavy. Carrying around silver is heavy. So to have that kind of value, it makes for a very difficult process of exchange. And that kind of coins are easy for people to steal. And so how do you then protect the value that you have earned by your contributions to the community if it's all represented in those little metal discs that, you know, we don't necessarily have the locks on our doors that are going to keep people out? So, to every problem, there is a solution. And the solution early on existed in the form of goldsmiths. The very people who stamped out those coins also had vaults. They had strong systems of security to protect the raw asset that they used to create the coins. And so, they started to rent out space in their vaults for people to store their coins in. These were essentially the first banks. People could have their bag of coins, take it to the goldsmith, and for a fee, the goldsmith would put it in their banks and give them a receipt saying, I am storing 20 gold coins for you. So as a result of this, and a result of the fact that they were actually the people who were creating the money, the goldsmiths became very wealthy. They were renting out their space to store gold coins, they were creating the gold coins, and since they had so much wealth, and a lot of other people didn't, they started to lend it. They started to say, oh, you need 100 gold coins to start a business? Yes, I'll give you 100 gold coins and you can pay me back 110 as you earn it. So initially, the bankers took other people's deposits and they loaned out their own money. But the money was still fairly heavy and cumbersome. When that person came to the goldsmith and said, hey, I've got this great idea for a lawn mowing business, give me 100 gold coins, the goldsmith would have to count out those 100 gold coins, hand it over, and that person would have to then carry it around to their various suppliers. So that meant, as a solution, the goldsmiths, the new bankers, started issuing notes that said, Joyce, starting her lawnmower business, has 100 gold coins in her deposit in the account. She could then trade that note for somebody to somebody for something else, who could then redeem it at the bank for those 100 gold coins. So the promise of the banker, of the goldsmith, was that they were holding in trust this sum of gold, and these slips of paper that represented that gold that's held in trust could be traded between individuals. Along with that, they then started to say, well, Joyce has 100 gold coins in her account. She could issue a directive to the goldsmith to transfer some of that gold to somebody else. And so the early checking was also formed, where Joyce could then write a check for 20 gold coins. That person could then take it to the goldsmith, And the goldsmith would say, oh yes, here's your gold coins. Oh, but you don't really want to carry that. Why don't you open an account here and keep the gold coins in the account? This essentially started what was called representative currency, or backed currency. So backed currency are, again, started happening when banknotes started to get traded between people. So essentially what would happen is Joyce would have that note saying 100 gold coins, and she might go give it to Patrick. But Patrick wouldn't bother taking it to the bank, because that's just a lot of rigmarole. He might take it to Brenda, and that banknote starts to get traded around the community, because everyone who receives that banknote trusts that the goldsmith has 100 gold coins that it can be redeemed for at any time. So the value of the note represented an asset that was being held in the bank. Interestingly, I didn't know this until I was doing a bit more research for this, the private banks here in Canada actually issued our currency until 1832. They would actually print Canadian dollars, and it was bank currency that was in circulation. But over time and through the late 1800s and into the 1900s, most governments set up central banks, and the central banks became the authorizing authority, the issuing authority for currencies. I'm going to do a little bit of an aside here because it doesn't fit in anywhere else. But this whole piece of representative currency is one of the things that, in a very large way, helped to create the debt crisis of the Southern nations. And it's a kind of convoluted story, because those of you who are older than me might remember a time when the dollar was fixed. You could exchange 4 US dollars for gold at the Federal Reserve. The long practice from the start of the American government back in 1776 was that the currency was fixed to that asset that was being held by the Federal Reserve. Gold was the asset, the US dollar represented that gold that was being held. Then in the 1939 to 45 range, there was a war. And the American government ramped up its expenditure and needed to be able to pay for everything that it was doing. So the Federal Reserve quietly started printing more money, recognizing that, in fact, people weren't asking for the gold. So we could just print more money, and it wouldn't matter. And that money spread around the world, and particularly in the European banks, following the Marshall Plan after the war, when a lot of American dollars went in to help rebuild Europe. There ended up being a lot of money in the reserve accounts of the European nations. So much so that in the late 60s, some of the European nations started to question the value of this money. And so they called it in. They went to the American government and said, we'd like our gold. Here's your money back. Give us our gold. Well, the Federal Reserve didn't have enough gold to cover the currency that was out in the world. And so in August 1971, Nixon declared that there would no longer be a gold standard, and the US currency would float. Interestingly, rather than collapsing the global economy, which is what everyone says will happen if we print more money, all the banks in Europe said, oh, okay, we can't get gold for this. But we have a lot of it sitting in our account, so what are we going to do with it? So the European banks went out to a lot of the developing nations and said, hey, you want to build a dam? We've got lots of money. We can lend you it. And pushed loans into the South in order to fund infrastructure development, not because the infrastructure was required, but because they had excess dollars sitting in their bank account. Anyway, that's just a, one of the impacts that this kind of currency kind of thing can have. Ultimately, and as part of the move away from representative currencies, what we now generally have around the world are systems of fiat currencies, where a particular currency is actually established by legislation. So rather than relying on our trusting the goldsmith that the money's there in the account, the government simply says, this is what we're going to use. Somehow it inherits the trust, and that's an interesting thing, because the Canadian currency is not backed by anything. The dollars that we have float around and we use them because we trust them. But they don't have any inherent value. So this is where it starts to, boggle minds. Now, going back to that goldsmith, you remember that, each of us have taken our 20 gold coins and put them into the bank. And we have all these banknotes that are circulating around to represent that. And in the meantime, the goldsmith is there with his 100 gold coins, lending it out for interest and taking the interest back. But he starts to realize that in fact, most people aren't ever coming to get their gold. They know that it's there, and they use the fact that it's there to do all of their economic transactions, but they never come to get it out. So if they don't come to get it out, then I could loan that money out as well. And they'll never know the difference. This starts a system of fractional reserves. This is where it really, I think, starts to blow minds. So, because they realize that only a small proportion of deposits are ever going to be called in at a given time, and all of those funds are just sitting there idle, not doing anything. We've got all those gold coins not doing anything. As long as everyone is secure that they can get their money out when they want it, we can lend it. Now, to be fair, they did it, fairly openly, and offered people the opportunity to share in the interest of that lending. So your deposit to the bank earned interest from the interest that was being charged on that money being loaned out. That's all fine and good when you think about it as gold coins being loaned out and gold coins coming back in. But that's not what happens anymore. We don't take the gold coins anymore and take them out of the bank and spend them and then pay them back. The bank creates an account for us and makes a deposit to that account, and we spend based on the value in that account. It's what I call double entry accounting magic. So, the gold's sitting there in the vault. The goldsmith/banker has these ledgers of tables saying, person A has an account, person B has an account, and I as a banker have an account. So when I as a banker loan out money, I create an asset for myself. Joyce owes me £100. That debt to me is an asset. But I also then create a liability. Joyce has borrowed there's my UK stuff coming through, 100 gold coins. So on my account, on my liabilities, I put 100 gold coins is owed to Joyce. It's very confusing. As a banker, her debt to me is an asset. But rather than give her gold coins, I create an account for her and put 100 gold coins into, I write down 100 into her account. So I've written down 100 over here and 100 over here, but nothing ever moves out of that vault. So by writing down those 2 entries, the banker has just created 100 gold coins. No cash is exchanged. Joyce then goes out, uses her debit card to pay for something, and the banker takes her account, which was 100, and says, oh, she spent 10. I'll take 10 out of that, it's 90, but that 10 has gone over here to this person's account, so I'll add it over here. So all of a sudden, there is money out there circulating by moving between accounts that has no frame of reference whatsoever to this gold that's sitting in the vault, or the initial amount of money that was deposited in the account. Is that somewhat clear? Good, because now it gets fun. So, this is just an example I've actually pulled off of the Wikipedia website page on fractional reserve banking. It's an interesting exploration if you ever want to go read it. So, this could be working within a system of a whole bunch of banks like we have in Canada, or it could happen within a single bank. It really doesn't matter. Joyce has come in and she's deposited 100 gold coins, $100, 100 pounds, whatever the 100 is. The bank sits back and says, yeah, you know what? We know that roughly 20% of people's deposits might be demanded at any time. So we'll keep 20% of her $100 in the vault so that when she comes to get out $20, we can give her that $20 and she won't panic. They then lend out 80. That 80 now becomes a deposit. And they think, oh, we need to keep 20% of that. We'll keep 16. And we can lend out 64 more. This carries on.
Yeah. Wow.
So if we take it through, this is just taking it through, I think, 12 transactions. It could go on forever. Each time, the value lent out becomes the next deposit. And a small portion of the reserve is held back, and the next amount is loaned out. What we then see is that at the end, we've got $89.26 that the banks are holding in reserve. We've got $10.74 that's the last deposit that was put into the bank. We haven't lent that money out, but we could keep lending it out and taking reserve. The sum of those two things is the $100 that was initially deposited. But in the process, the bank has lent out $357, and there's total deposits of $457. So from that $100 deposit, all of a sudden $457 is available for people to use. So the banks create money.
Is this a good time to take a break, or do you want to finish a point?
I've got two more slides and then a break. So this is where it really starts to, okay, well, how does all that affect us? Fractional banking has been occurring basically since people started to realize that you could abstract the paper notes that are circulating from the money that's in the vault. But it has run into difficulties in the past. So first of all, if the depositors lose trust that the bank has the capacity to give them back their deposits, they might try to take it out. Now, if the bank at any point were to hesitate, and word got out that the bank was hesitating, people might panic, and it creates a run on the bank. Mary Poppins has a great little scene with a run on the bank, and the bankers have to push the doors closed to keep the crowds out, to keep the bank alive. Because if the bank were to try to pay back everyone's deposits, it could not, and it would fail. So, we've, as a culture, have kind of learned from this. Banks have failed historically quite often. They still do fail in the United States and other places on a fairly regular basis. We haven't had any significant failures in Canada for a very long time. We mitigate the chance of this massive failure by dictating to the banks how much money they have to keep in reserves. Now, interestingly, for the past 20 or so years, Canada has had no reserve ratio. So it is entirely up to the banks to decide how much they feel they need to keep in reserve to be able to meet the demands of their depositors. So we as a government don't tell them anything. We just let them set it up their own, which does mean that they make that basis on risk factors. They make their own determination of what is the likelihood people are going to require to take out money against what's the potential profit we can make. And they're balancing those two things on our behalf. So the other thing that we've done is we've created deposit insurance. This is essentially the banks paying a small fee to a government agency to insure depositors' funds, so that if there is ever a bank collapse, depositors' funds will be restored to them by the government. So it's essentially taking that risk that the banks are bearing in setting their own reserve ratio and transferring it all onto the taxpayers. Which you can imagine is giving a fair amount of freedom to the banks to make decisions that maximize their profits. We have been lucky in Canada. Not so lucky in the States, and certainly not so lucky in Iceland. And in Iceland, they actually had a deposit insurance system in place for their depositors that couldn't afford to pay for the banks when they collapsed. And so they then made a decision at that point in time that the Icelandic bank deposits would only be covered for people who live in Iceland. And so I lived in the UK at the time when the Iceland banks collapsed, and a large number of the pension funds of the local municipalities were invested in Icelandic banks. And so they were just wiped out, just like that.
Because Nixon took
Gold standard away,
gold
yeah.
standard in 71. Apparently now the American dollar has lost 95% of its value. So there's only technically 5% of value left.
Yeah.
So how does that translate?
Well, it is. I mean, it's an interesting thing to look at because I mean now we price gold. You know, the price of gold seems to fluctuate against the American dollar, when in fact it, historically would have been seen as the gold was the fixed and the U.S. dollar was the fluctuating thing. We've turned that around in our head and we've said this is the solid value and the gold is fluctuating, but gold doesn't really fluctuate. Gold is gold. It has a value. It's an intrinsic value. And so what's fluctuating is people's trust in the U.S. currency and its ability to meet its demands.
I think more people are realizing that there's no value in the money printing now. Like the paper money, the value's not there.
There are some movements in the States, and I mean, I don't like them, but the Tea Party and Ron Paul are big proponents of trying to bring back the gold standard for some of those very reasons.
Okay. When Marty finishes this piece, we're going to have a little break and a chance to ask questions. And then Marty will give the second part of this.
But it is there is an interesting stat that in the 34 years prior to 1971, the amount of U.S. currency in circulation almost doubled in those 34 years. In the 34 years immediately following, from 1971 to 2005, the amount of U.S. currency went up by a factor of 13. So that essentially caused an explosion in the currency, because it was no longer fixed to how much. There was no legal requirement for them only to print based on how much gold they had in the reserve. So I mean, all of that has an effect on people's sense of value of that currency. So the other major problem of fractional reserves as we practice it is that it causes inflation. Because, and again, this is one of the things that really it angers me about the way we have created our systems here. The banks lend out money. They create the money by lending it. And when they create that loan, they attach interest to it. So not only are you expected to pay me back the money that I've created for you, but you have to pay me back a bit more than that. So when Joyce comes and says she wants that 100 gold coins, I say, yeah, I'll create 100 gold coins for you. I want you to pay me back 110. Where does that extra 10 come from? Fundamentally, from an individual, she thinks, okay, well, that's fine. I can earn enough profit to be able to pay that back. But it still has to come back in the form of a currency. And if the only way we're generating currency is by creating it based on loans, then the only way to have Joyce be able to pay back that loan is to push another 10 gold coins out into this economy so that there's enough for her to be able to gather and pay back. So ultimately, the amount of money that has to be repaid exceeds the total amount of money that's in circulation. And so our economy has to continue to grow. The amount of currency in circulation has to continue to grow in order for everybody to be able to meet their debt obligations. If it doesn't grow fast enough, somebody cannot repay their loan. So it essentially means that there's basically a built-in requirement for failure. It sets us up so that Joyce, who has borrowed 100, and Pat, who's borrowed 100, are competing for that extra 10. And one of them is going to lose. That's what makes me mad. is we have created a society that created a system that has really put private banks into a very privileged position of being able to introduce something, to create something, which is our currency, and charge us rent for it. It doesn't exist. They're taking something that doesn't exist and earning money on it. And as a result, putting the whole of our community into a system that forces us to do more and more and more and grow and eat the world up in doing so, in order that we can pay them a profit from something they don't even have.
Record profits.
So, just quickly, what do banks do then? Fundamentally, there's three things that banks do for us. They safeguard our monetary assets. There's those vaults things. Now, interestingly, there is about 35 billion Canadian dollars in circulation, actual paper and coin money circulating. At any given point, 2 billion of that is held by the banks. And the other 33 is circulating between people. So in terms of safeguarding our money, they're really actually safeguarding paper accounts as opposed to the money itself. But it also shows you, when we talk about the size of the Canadian economy being in the hundreds of billions or trillions of dollars, and we only have 35 billion in cash, just how that currency creation has happened and is happening. So, I mean, I don't want to kind of wash over and paint a really horrible picture. Each one of these items that banks do, sorry, I didn't read the other two. Banks facilitate economic transactions. They help us trade money. And they create money as borrowers require it. And ultimately, all three of those activities are needed for us to have a healthy human environment. We need to be able to access currency to pay for what we're purchasing and to be paid for what we're producing. As we're doing that, the currency in itself isn't the thing. It's the exchange of the labor and product that is the thing. And so we do need the ability to create the currency in order to recognize that trade of value. So all of those functions are necessary. But the banks, as we know them, basically manipulate all three of those services in order to generate a profit for their shareholders. That's their fundamental driving purpose, is to create a profit for their shareholders. And so, although we ask them and require of them to do these three things that keep our society functioning, they abuse that privilege in order to extract money for their shareholders. So, break in discussion. There's a lot of stuff online if you want to kind of get into fractional reserves and the issues around it. I went back to the original question that there were two posters that went out about this event. And so one of them said, "Making your bank your ally," which is the one that's out the door out there. And I saw that poster go out and thought, oh, that's not what Joyce and I had talked about, and I have no idea how to make your bank your ally.
Well, Patrick's here, he's going to help us.
Yeah, but with that, I mean, I think there are some choices that we have in terms of saying, okay, we have to work in this economy. We have to work within the systems that we have, and we have to survive as human beings and do the best we can to do so ethically and sustainably. And so we ultimately only have a couple of choices when it comes down to it, and one of them is to try to work with our banks. And so I thought, well, let's think about, how could we best work with our banks? And I think the first thing is to be really intentional. Know what it is you need from your bank. So all of us, almost without fail in Canada, need transactional banking services. We need those debit cards, we need checking capacity, we need the ability to access cash when we need it. So that fundamentally is one of the services we need from a bank. Most of us also need credit of some kind, whether it's credit cards, mortgages, car loans, all of those kind of things. Now there's all kinds of organizations that can offer credit beyond banks. And so, in terms of thinking about what it is you want from your bank, you may want to think about how much of your credit do you want to be based on this banking system, where some of the other credit that may be available isn't necessarily based on a fractional system. So you could borrow money that is actual money, as opposed to borrowing money that the bank, because of its legislated charter, is able to create for you. And that would be particularly true with non-bank mortgages. where basically the mortgage is provided by private organizations that are funded by investments of other people's savings. And so those kind of loans are actually those investments being passed through the loan rather than a fractional creation. I don't know, you might have a better idea of how many of those kind of companies operate in Canada. I don't think there's many. In the UK and the US, there are a lot of non-traditional mortgage lenders.
Private lenders too?
Yeah.
Yeah, private.
Yeah.
Yeah, private.
Yeah. All right, and then of course, the idea of having savings in a bank. And I think a big thing is to consider how much you want to have your savings being available for banks to lend against. I mean, there's a lot of reasons to consider why you want to have your savings resting in a bank anyway. It may not be the most efficient and productive method. It tends to be the safest method. You know, you put your money in a savings account, you're always going to have that money in a savings account, and you might earn a little bit of interest on it. But you'll potentially earn more through other investment vehicles. That said, there are a lot of banks that say, you know, we'll give you free banking if you keep a balance of X thousand dollars. And that's essentially because they know they don't have to earn fees from you because they're earning the interest off of the multiple lending of your deposit. So they can then say, yeah, hey, we'll waive that $14 a month if you keep $1,000 and we're earning based on that. So those are, you know, some of the things to consider. But I mean, ultimately, the banks are there. They provide a service, and they try to earn a profit for their shareholders. So our participation in that, it's part of participating in a capitalist system. But I think having the awareness that the bank is using your savings in order to reloan in a method that creates an inflationary environment is something that we ought to be concerned about. So the other thing, I think, is that if you're saying, you know, you need to use a bank for a service, then just be prepared to pay for that service. You know, we pay for everything else that we make use of. The bank is offering us a service. It's offering us those transactional exchange. It's offering us access to credit. Those things are things that they provide to us and cost them to provide us. So our payment to them is compensation. So I know that there's a real tendency to push for you know, fee-free banking, but a lot of those fee-free banking is based on them making money in other ways. And so it may be more ethical for us to say, hey, I'm going to pay you for what you do for me, rather than I'm going to give you my $1,000 for you to loan out $10,000 to other people. So, and then I guess the other thing with the bank is just, you know, build a relationship. Find somebody in your branch who you can get to know and get to trust. But also, I think, be aware that a lot of times the people in the branches, they follow the rules that the bank set. They don't necessarily know the whole theory of the structure of the banking system. And so they're limited by the rules of the bank, and the rules of the bank are formed in order to earn a profit for the bank. That said, there is some flexibility, and getting to know people and getting to trust people and getting them to see you as a valued customer in and of itself, apart from all of the regulations, can help when it comes to getting your bank
Best service.
the best service. So, an alternative to the banking system is credit unions. So credit unions are member-owned financial institutions. So every single person who deposits money in a credit union owns a part of that credit union. The expectation, and it's gradually changing a bit, is that all the members of a credit union share a common bond. It helps to build trust among the membership for them to have something in common. So I don't know if it's the same anymore. I think you've opened up your bond, but the Frontline Credit Union used to be for employees of the paramedic, fire, police services, the frontline responders. So its common bond was they were employees of those services. Over time, the common bond philosophy has been shifted a bit so that now it's much more a geographic-based common bond. So to be a member of a credit union, you live within the common bond region of the credit union. But even that is then still saying, you know, we all still have something in common. We have something that binds us together. And it may be our locality, but it does mean that I'm not expecting the same from my financial institution here in Westboro as a person in Victoria is expecting from theirs. Whereas our chartered banks are quite clearly beyond those geographic boundaries. So ultimately the goal of a credit union is to serve the needs of its members, not to maximize profits. That said, credit unions can be profitable, and their profits belong to the owners. And the owners of the credit union are the members. So the profits that credit unions can generate return to the members and get reinvested into the community. They're almost entirely local based in terms of most of them have a geographic bond. There's several of them that have an Ottawa common bond geography. I'm not sure of the Ontario regulations precisely, but most credit union regulation allows a certain percentage of your credit union membership to exist outside of the common bond. So it's not exclusive, but the vast majority of your members form part of that bond. And also, unlike the banks, who are run by a board that's appointed at the AGM of shareholders who have a vote based on the number of shares that they hold, the board of a credit union is elected on a one-member, one-vote system. So it's basically much more of a cooperative model as opposed to a corporation share-based model. You can own multiple shares in a credit union, and people can own different amounts of shares. But as an individual, you get one vote, regardless of how many shares you own, regardless of how much service you use of the credit union. The board is elected from the membership, and a part of the implication of that is that they're like you, they're like us, and that they're more accessible. So it is actually possible to talk to a board member of a credit union, whereas I challenge you to talk to the board member of your bank. Unlike our chartered banks, credit unions are provincially regulated. The chartered banks are federally regulated, so the regulations for credit unions differ from province to province, and so that's why you'll see the Caisse Populaire in Quebec operate slightly differently than the credit unions in Ontario. They're under different regulating legislation.
Where to go?
Now, unlike the chartered banks, credit unions do have quite firm and restricted ratios that they have to monitor. So liquidity ratios in terms of how much money do they have of their own capital compared to depositors' capital compared to loans out into the community. They have very, very tight reserve ratios as well. So the chartered banks, we've basically said, fractional reserves, you choose how much you think you require to be safe. With credit unions, the expectation is that they will conform to a legislated value. So that said, ultimately, credit unions are participating in the same kind of fractional reserve system. So they will loan out based on the deposits that they've received. But usually they have a reserve ratio of 8 to 10%, I think. Again, I don't know the Ontario regulations very well. But there's a reserve ratio they can't lend beyond. And so that their ability to participate in that fractional reserve system is more limited. It's also more limited because with the chartered banks, if they lend out $100, it goes into somebody's account in their bank. They might trade that. They might then do transactions with somebody else who might be at the same bank, and so the deposits stay in the same bank, or it might go to one of the other banks. But ultimately, they don't ever trade money with the other banks. They just trade liabilities with the other banks. And so, as a whole, essentially the banking system in Canada works as a single entity in terms of the way the fractional reserves play out. The credit unions participate in that, but ultimately, because they're much smaller and because they have those reserve ratios, their multiplier effect is much smaller. Credit unions have a more restricted set of services that they can offer to members. It varies depending on the class of credit union that they are. And so there's the regulations tend to most places set out a class 1 versus a class 2. And they have different reserve requirements, they have different capacity to lend different types of things. In Ontario, you become a class 1 credit union if your capital exceeds a certain level, or if you either make a business loan or a mortgage. And so there are a lot of credit unions that don't do business loans and don't do mortgages because their class, I'm getting the classes confused. You might know more about that.
Distinction either.
But generally, the smaller credit unions will offer a much more restricted set of services and tend to be more oriented towards savings accounts and the various permutations of that. So savings accounts, checking accounts, so deposit accounts, and they'll do personal lending. The larger credit unions will get into mortgages, will get into business loans, will get into providing business transaction accounts. And they are also covered by deposit insurance. Now, instead of being the Canadian Deposit Insurance Corporation, they're the Deposit Insurance Corporation of Ontario for our context. The coverage is the same, but the rules are slightly different. And so some of your deposits in certain types of activities in the larger credit unions may not be covered by the ODIC. Interestingly, because credit unions are provincially regulated, they also fall under a different set of regulations for mortgages and for home lines of credit. And so all the talk that we had recently of Jim Flaherty shutting down the flexibility of mortgages, credit unions actually still have more flexibility in terms of the mortgages they offer because they're not regulated by Jim Flaherty. So now I'm duplicating myself. So credit unions offer savings, two forms. One is member shares. So that's an amount of money that you actually invest in the credit union. It becomes part of the credit union's capital and helps in terms of maintenance of their reserve ratios and the long-term financial stability of the credit union. And then also deposits. Deposits aren't capital of the credit union, they're a liability to the credit union. And so they do have to maintain an appropriate ratio between the total amount of capital, which is made up of profits that they've made in previous years, plus the member investments, compared to total deposits. So that's one of the ratios they have to keep. It also plays into the actual starting of credit unions, because anybody can actually start a credit union. if you find people that you feel you have a common bond with, you want to start a credit union, you can do that. But in order to do so, you have to meet minimum capital requirements that are set by the regulations in Ontario. And so it in part depends on the size of your common bond and the services you plan to give, but I don't think there's been a credit union historically that's been started with less than $250,000 of capital. So if you want to start a credit union, you need to get all your friends together and somehow have enough money to invest $250,000 to get it going. So most credit unions also, well, all credit unions do some form of transactional banking, even if it's just checking. But most of them have now moved as well to electronic banking systems, debit cards, and internet banking. The credit unions, even though they are essentially much smaller, locally owned, they participate in both the Ontario network of credit unions and there's a Canadian network of credit unions and a worldwide credit union network. So they all participate in all of those levels. And as a result, there's a sharing of electronic banking capacity. So if you're a member of Frontline Credit Union, they've got their bank machine in the front room of their building there. But you can also use your debit card at any credit union machine across Canada, at various other Plus and Cirrus network ATMs around the world. So HSBC participates in the Plus system. So you can use your credit union ATM card free of charge at any HSBC machine. So it's quite a wide network, and so that even though they've got the very local focus, their networking across Canada has given them a fairly global scope. And they offer credit. So loans, mortgages, lines of credit, and credit cards. I'd love to be able to say that credit unions are more flexible and more needs-driven in terms of meeting people's needs for credit. But the opposite side of that is that in a lot of cases, credit unions can end up being more risk-averse than banks because they are lending out their members' funds directly, and they have to be accountable for all of that. They are going to be, as strict, if not more strict, than the other banks in terms of meeting minimum credit requirements. And many of them also have partnerships with MasterCard and Visa to offer credit cards. So, did you want to say anything about at this point, or do you want to just leave it for questions? Or
I could leave it to questions. I guess I could touch in on the whole exchange network and the Plus and the Cirrus, and how that kind of really falls in line with the cooperative movement as a whole. We work together, all credit unions have a common bond within one another to help each other and provide this service for their members. And beyond just, say, taking out money service charge free within the exchange network, there's over 2,400 ATMs across Canada. A lot of the participating locations also accept deposits. So that's another way. So it's not just not getting dinged for taking out your money. You can also deposit your money should you have a lot of cash on you and you want to be safe while roaming across Vancouver, for example, or whatnot. But that's another little example. As far as being equally as stringent on lending practices, I think knowing your bond and knowing who your members are allows you some flexibility on lending because, for example, because we were started by firefighters, we really understand the salary, the augmentation, the different classes of firefighters as they grow and develop in their career. And some banks may say, well, you're not making a lot of money as a pro-B firefighter. We understand, well, in 3 years from now, you're going to be making almost double that salary. So we'll lend you the money now, understanding that you're not a risk. Once you're on the fire department after training, for the most part, 95% of them remain on the fire department at a very low risk. So just understanding your members and having that relationship, which is what credit unions are all about, knowing your members and being small and nimble enough to act on certain things and finding those needs for their members.
There's a membership fee as well. It's probably important to, I think that's
Yeah,
true for all
That's,
credit unions.
that's your share purchase.
Yeah,
Yeah,
it's shares,
so
yeah.
you could see it kind of as a deposit.
Yeah.
It's a share purchase. It's your right to vote at the annual general meetings, your ownership share within the credit union.
Mhm.
However, should you decide to take all your money out and then leave your membership, that's entitled to you upon leaving.
Oh,
So
okay.
it's still your money. You
Oh.
get that back.
And in fact, most, I shouldn't say most because I've only been in a few of them, but many of the credit unions that have reached a size of being consistently profitable are also now paying dividends on the member shares. And so not only when you leave the credit union can you cash out your share and take it back, but you've also then shared in the profits through receiving dividends on them.
And then there's also
Differs on credit.
charitable. The credit unions can offer charitable things back to the community, charitable support. So I can't remember, you mentioned some of them, but
Yeah, and that's a lot of it stems back to the common ground. You try to get back to what your members value.
yeah.
So in our case, we're very active with the firefighters, giving back to, say, the parades. And we get involved as well. Like we have a float within the parade. With the health groups, we get involved with their foundations as well and give back in that way. As we develop more community awareness and develop more membership within Westboro, we want to become involved within Westboro and the charitable foundations in the area as well. So really, the nice thing about credit unions is they focus on what their members want and what they value for the most part as a collective group.
And again, because, in a sense, because they're looking for their members' interests rather than for their shareholders' profits. I mean, ultimately, their members are their shareholders. But the idea of the members' interests become broader than the corporate idea of a shareholder profit. So in the corporate world, the being run for the benefit of your shareholder exclusively means earning that shareholder a profit. For the credit union, being run for the benefit of the members involves potentially making a profit, but there is then more freedom for the board of directors to say, you know what, we're not going to give a dividend. We're going to take that $10,000 and invest it in the Westboro Business Improvement Association, because that will improve the lives of the people in the community. So the idea of what a member interest is much broader than just the financial return that a shareholder would expect.
I had a question.
Oh, just about the roughly how much are fees to become a member? How much are
They vary.
There's a range.
It
Yeah.
varies on credit union to credit union. For us, for example, it's a $75 deposit.
Okay, so it's
And
not
that
750, it's
No,
75.
no.
Yeah, okay,
Yeah.
so,
Yeah, I think
Okay.
it can go as high as 250.
yeah.
But I think it's largely some of the very small credit unions that would have that high a level. And generally, the larger the credit union is, the less they have a need of that kind of infusion of capital, because they would have been operating profitably already. And so they would have capital built up from their retained earnings. And so, like, I think Alterna is $15 or $25 as a share, a membership share. So it very much depends. But again, the identity and the culture of the credit union also changes. So, Frontline is a very different credit union than Alterna. Alterna feels more bank-like.
Well, it is a bank now, so what's the difference there?
Well, they actually have both. So Alterna Savings is still the credit union, and then they operate Alterna Bank as well.
Oh, I see.
So there's actually two separate organizations. I'm not sure exactly how they work that out, but Van City had done the same thing. Van City Credit Union, which is the largest credit union in Canada, had started up Citizens Bank and offered banking services across Canada for a number of years.
And the movement's quite large out west, actually, more so than Ontario. Like Van City, for example, is
Yeah.
huge. Coast Capital, they're a massive credit union as well. And Meridian is slowly becoming a large one in Ontario as well, and they will be in Ottawa very shortly, I believe. And they're kind of like the Van City equivalent to Ontario.
Yeah. to be fair. And the ones that there are very limited in their scope. They're not necessarily limited in their potential, but ultimately most of the people who are buying into them and promoting them are people who have got a grasp of some of the complexities of the banking system and are enthusiastic about finding alternatives. But participating in these kind of systems takes a lot of effort and a lot of work. And so unless you're converted, people aren't likely to participate. So building up other options is kind of the key thing. So the first idea is having backed community currencies. So going back to the whole idea before of representational currencies that represent something, some other underlying asset. And so what is being used in a lot of places is a system where a local currency is created, actually physically printed up, and it's backed by people buying it. So we might create a Slow West dollar and sell those Slow West dollars for face value. And Slow West then takes the money that they sell the currency for and puts it into a bank or in some kind of investment vehicle where people could then call in their Slow West dollar and take out their original money. So that means that Slow West dollar will always have its same dollar value because people know that they can go cash it in at the Slow West office when we have an office. But it allows it to exchange amongst people who are aware of that value and feel that it's an accessible way to keep their value. So the value of a backed community currency is that it ensures that the currency circulates locally. So, if we went and spent a $20 in Canadian funds at Herb and Spice, that $20 could end up going anywhere. It could go to pay their producers, it could go to pay their suppliers, it could go to pay their staff. And so, Herb and Spice is a bad example because it's locally owned. But if you went into Mountain Equipment Co-op and spent your $20, it's going to, potentially that $20 could leave the community and be gone entirely. With a backed local currency, that Slow West dollar, if MEC were to accept its value, they would then have to pass that $20 on to someone else in the community who would recognize its value and be prepared to accept it. So it keeps the money circulating locally and keeps the exchanges happening locally rather than allow the funds to be gradually drawn out of the community. So there's a couple of examples that are working fairly well. The Salt Spring dollar on Salt Spring Island near Vancouver, Victoria, between them, has been operating for about 20 years. They have currency that they had commissioned artworks from famous Canadian artists, had printed up by the Canadian Banknote Company, who are the same people that create our Canadian dollars. And they sell those and they circulate on the island. Now the advantage of having them had commissioned the artwork is that people are also buying them as souvenirs. So they buy them as souvenirs, leave the money behind, leave the Canadian dollars behind in the community account, and take that nice souvenir home with them. And so over time, the Salt Spring Foundation has built up a substantial amount of money that backs the currency that's circulating on the island. There's also one that was starting up in Toronto in one of the market regions, and I can't remember which one, but a Toronto dollars. And again, you could go and buy from a kiosk, $20 in Toronto dollars, and then go use it at the vendors within the market. And the vendors would accept it at face value, and then could go and redeem it at the end of the day, and it ensured that the money stayed within the market.
Is it usually traded one-to-one?
Usually one-to-one. Sometimes with the backed currencies is what they'll say is they would it would be redeemed for well, and it's interesting. Sometimes they try to create redemption rules that try to keep it circulating. So it may be that each bill is given an issuance date. And if it's redeemed within a particular time frame, they only get 80% of face value. And if it's redeemed out, later on, it's 90%. And if you hold it for if it circulates for 2 years, you get 100% of the value back. So the idea is to try to create redemption processes that keep it circulating rather than allow people to cash it in. The other advantage of that, is that whoever it is that's issuing the currency has taken in all of the money that they've received as face value. They can then invest it, earn earnings on that, and reinvest the earnings in the community. And so if we were to issue a Slow West dollar and issue $10,000 of them and have them circulate amongst businesses and people within the Kitchissippi ward, then ultimately that $10,000 could be invested into the solar project.
Solar co-op, yeah.
The solar co-op, and earn income from the solar co-op that then could be reinvested to beautify the parks or do whatever needs to be done. So it's kind of a way of trying to encourage community-based economy. The challenge is that you do need to have business participation because the businesses have to be willing to accept the dollar. They also then have to have outlets to be able to use the dollar. So sometimes that means negotiating with staff that some of their staff would accept the local dollar as some of their pay, or that they'd be willing, in some cases it's just a matter of saying, well, yeah, you know what, this is a discount scheme that we're offering to our local community, and we're just going to cash it in at 95% of its value, and we'll lose 5% of its value each time. Mm-hmm. That's less than most of the coupons they're going to be accepting. So there's lots of ways to do it. So now another system, and in some ways this one I think offers more potential in terms of transformation of a whole economy, but at the same time is harder to get working and requires more buy-in from the people who are taking part in it. A mutual credit system is basically taking the same concept as fractional reserve banking, except skip the whole idea of the deposits. We can just generate currency by saying, hey, Joyce, I'll sell you this and you can owe me it. And so finding a way to record the overall amounts of contributions and drawings that people put into a given community. So over time, the whole system remains balanced at zero. There will be the same number of people who have over-contributed as there are people who have contributed less, under-contributed. Your positive accounts will be exactly equal to your negative accounts. But the total amount can change. So this is basically going back to that whole concept that I named earlier about currency having a false scarcity. There doesn't need to be any scarcity in our currency as long as people are willing to accept the obligations and debts of each other. The currency itself can be created with each exchange. As long as there's a way for us to track and maintain people's levels of balances of creating and accepting those currencies. So yeah, basically any member, mutual credit, any member can create currency by issuing credit to other members. The most famous of these, the key difference from the kind of fractional reserve system in the banking system is that the credit that's created between members doesn't draw any interest. And so it can grow and expand or contract as the community needs. It doesn't have that inbuilt requirement to recontribute more than has been borrowed. So the best known example is the LET system. It stands for the Local Exchange and Trading System, and it was actually created by a Canadian in Comox Valley, in Nanaimo in Comox Valley. And it's essentially that. People join the system and get accounts. Your account starts at 0 and you start trading. And your account can go negative or it can go positive depending on how much you've contributed to other members, how much you've sold or purchased in terms of services and goods. There's a lot of challenges to LET systems that people have worked out in different ways. Anyway, I think they're very promising in terms of what they could offer. But it does involve rethinking what we know about money. Because basically it's saying we're creating currency that has value because we've said it has value. We're creating a means of exchange and a means of tracking the changing levels of our community's contributions to each other. And we're not going to put anything away in the way of having those transactions happen.
About 5 more minutes max.
Yeah. So the mutual credits, you might remember Argentina defaulted on its global debt back in the late 1900s and early 2000s. Their currency crashed, buying power from people evaporated, unemployment spiked out of this world, and so people went to mutual credit and simply created a whole underground economy of trading because they could. They didn't need the currency that had collapsed. They didn't need to have the symbolic currency coming through their standard employers. They just worked for each other and paid each other. So there's a group in Ottawa that's trying to work on community currencies. They're connected to both Slow West and Transition Ottawa. It's the Ottawa Community Currency Network. They've set up a software to run a trial on a mutual exchange system that they're kind of doing some initial testing on. But the hope is that they're wanting to get that up and running in the next year or so and try to offer it citywide. And anyway, that's their website. They meet, I think, the first Mondays of every night or every month, which means I can never go. But so anyway, that's all I had. So.
Wow.
Very enlightening. Boy, thank you, Marty. That is fantastic. Do you want to come up, Patrick, as well? And we have about 10 more minutes to ask these guys questions or make comments. Add what you know to the mix.
That's great. Is there a routine?
Well, I guess one question with local currency, I've heard of some governments participating because if a vendor relies on alternative currency, how do they pay their workers or taxes or that kind of thing? That's down the road, obviously, but yeah.
Well, it is and it isn't. There actually are Revenue Canada bulletins on barters and community currency exchanges.
Okay.
Because, I mean, ultimately, the government wants to make sure they get the taxes that come out of any kind of transaction. And so that's what I was saying. You know, legal tender in Canada is actually anything that the two people involved in a trade are willing to accept. And it's taxable. so you know, even if you're using the Salt Spring dollars or the a LET system, if you're doing it as part of your business, you have to track it as part of your income and pay tax on it. So not many governments that I know of are yet participating in terms of accepting the payment of their taxes in that form. But that is one of the arguments, is that, well, hey, if I'm being taxed on that exchange with that currency, I should be able to pay my tax in that currency. I don't think anyone's won that argument yet.
this prevalent in the States, this type of system going on now?
The LET system?
Yes.
Yeah, there are. They're kind of all around the world.
Yeah.
They tend to be fairly small scale, and often start with great hope and ambition, and over time end up being a way for people to trade crafts. So I mean, that's the real challenge, is how do you move it out of people doing it for fun and as a hobby to people making it a part of their
mainstream.
Yeah. And what made the Comox Valley system initially very successful was there was a dentist who was willing to accept the LETs as payment for his services. And so people looked for ways to earn them, because then they could pay for their dental services. And so once the dentist left, people didn't have the sense that there was something that they could replace from their usual day-to-day life. And so the system gradually slowed down and eventually, I think, shut down.
Gold standards to gold fillings.
Yeah. But yeah, I mean, it does come down to utility. If there's something that you feel that you can get out of it, it's the same. Ultimately, it's the same with the backed currencies to try to get them circulating. For a business to accept them, they have to know that they can pass them on to somebody. For a staff person to accept it as payment, they have to know that they can basically replace their usual expenditures with that currency.
I have a question, I guess 2 parts. Banks can invest also, like they can invest in the tar sands and so on with their money, which is kind of interesting. I just wanted to know more about that. And don't they also have a reward system for the CEOs and so on in terms of profit making? And how does that compare with credit unions, with the CEO making just a salary, or is there a reward system?
Do you want to speak to that one on behalf of the credit unions? Or?
I could speak on behalf of, a slight difference with credit unions as far as salary expectations and such. For example, a wealth manager, and it all falls back again to really focusing on the member groups. He's concerned with making your money turn the best possible profit within your risk tolerance and what you want and where you want to invest your money, not the flavor of the month RRSP or investment avenue, whereas some of the bank investors are making commission on certain things and pushing certain investment vehicles because they can make money off it. That doesn't happen in the credit union system, and also the CEO again is making a flat salary, and there's no bonus structure built in on profits, because although we want to make a profit, everything is then filtered back to our members. So the profit that we do, every credit union wants to be profitable and wants to grow. That's for the greater good of the membership group. But the profits are then filtered back within in buying products and services, improving services for their members, as in, for example, with us, we just got a brand new website. That costs money and that drops your bottom line. However, our members are granted better service online and more services because of it. So that's part of it as well, or paid out in dividends, as Marty was saying too, within the membership group. Now I don't know how the bank CEO structure really works as far as
I don't think anyone knows.
Yes. I know they make an exuberant amount of money.
Closely guarded secret.
Again, because credit unions also have tended historically to attract certain type of individuals in terms of the people who are going to show up at the AGM to vote, and the people who are going to run for the board are people who are concerned about their community, concerned about the ethics of their money use. And so in a lot of credit unions, they do have strict policies about what multiples their staff can be earning from each other. So the CEO of the credit union will never earn more than 2.5 times the salary of the least paid employee kind of thing. Whereas a bank, they do it based on a bonus culture. They're, if the top people are seen to have been maximizing the return for the shareholders, they're going to get rewarded. But those rewards don't necessarily filter down through the whole staff who delivered the service. So
Is there less in Ottawa now? There was one some time ago. My son was involved in it, but my son has died about 13 years ago. And I'm wondering if Let's still exists in Ottawa.
The Ottawa Let system shut down in 2004. It had run, I think, from 1992 to 2004. And that's the exchange system that OCCN are trying to start up is basically a Let system. Historically, the Let systems were run by, individuals keeping ledgers in books. So it was a very manual process. But the more recent ones are now using kind of these online accounting systems that, the one that they're testing actually has the capability to have cards associated with it that can be read by, certain card readers and payments made by text messages. So they're trying to find ways to make the trading easier, because that was one of the things that actually made Let's fail, was that it was actually very cumbersome to operate. So hopefully in the next few months we'll see a new system. Be interesting to start up.
Well, we're supposed to be moving out of here by 4:30. Again, thank you, Marty, and thank you, Patrick, for coming. Amazing. And that's all the series are on the Slow West website. So, I mean, you always have to listen to this stuff like 3 or 4 times before it really
There's so much
sinks in. So Adam has filmed them all, volunteering to do it, which is wonderful. Thank you. But you can tune into Slow West and show them to somebody else or watch them again. And stay tuned for other learning series.
And on these topics, there's actually a lot of resources on YouTube and online about the banking system, the fractional reserve system, but also a lot of really good stuff on credit unions, because a lot of the credit unions have done a lot of good promotional work, trying to describe what their difference is and why, ultimately the world would be a better place if we all chose to use credit unions.
And also that we have some flyers in the back from Frontier, and you can just take those if you're interested. This is not a sales job for Frontier, but we just like it.
They're local.